Hi there, Stan the Annuity Man, America's annuity agent, licensed in all 50 states, the top independent agent in the country. I'm proud of that because we're doing it the right way. We're giving people the facts. We're giving people access to our annuity calculators where they can run them 24/7. But today's topic is a good one. You know, we shoot these videos all the time. Undisclosed location, we can't give that away. It's just not on the East Coast. Can we say that? That's all we're going to say. But what we're going to do today is answer some actual questions that were posted on the YouTube channel. Now, we've already answered them, because we do that, we check things. But what I want to encourage you to do is put a comment down there. You might make the next Stan the Annuity Man YouTube video, and that is a good thing. Now, the cool part is they wrote the questions out for me, so you're going to see Stan read, which is scary, right, with my eyesight. I'm going to read the questions, I'm going to answer them, and maybe it'll motivate you to ask a question as well. But let's listen to some music now. So here we go. Once again, we are going to answer questions that have actually been posted on my YouTube channel. Cool stuff. Let's go to the first one. I'm going to hold the paper up, so bear with me while I read. If I have a non-qualified MYGA, multi-year guarantee annuity, can I pay taxes yearly on the interest earned each year, or do I have to defer paying taxes until the annuity matures and I cash out? This would assume taxes were paid using non-annuity funds. Thanks. Great question. Multi-year guarantee annuities are the annuity industry's version of a CD, okay? No moving parts, no market attachments. You choose a specific duration, you're going to get a guaranteed annual interest rate for that duration. Now, with non-qualified accounts, non-IRA accounts, the interest with multi-year guarantee annuities grow and compound tax deferred. All right, there are some there with simple interest, etc. But on our feed, if you go to the site, theannuityman.com, and click the live MYGA feed button and go to the rates, we've figured it out from the standpoint of the yield to maturity shows a compounding number. So the bottom line in answering this question, you can just let it ride. You can let the interest compound and defer. Now, when you do take out the money, you do cash it out if you decide to. You don't have to. But if you decide at the end of the duration, the surrender charge time period, hey, Stan the Annuity Man, just send me all that money back, then you're going to pay taxes on the interest only at ordinary income levels. Now, obviously, you can use multi-year guarantee annuities in all account types, IRAs or Roth IRAs, or in this case, non-qualified account, a non-IRA. But the question was, can I pay taxes on the interest? The answer is no, and you shouldn't because it's deferred. The biggest difference between a CD and a MYGA is the fact that with CDs in a non-qualified, non-IRA account, you have to pay taxes on the interest annually. With multi-year guarantee annuities in a non-IRA, non-qualified account, you do not have to pay taxes annually. It grows and compounds and you can pay them at the end, or at the end you can just transfer it once again and push the tax buck down the ice. You can just transfer it to another MYGA. Now, does that tax deferral make MYGAs better than CDs? Absolutely not. I mean, these are apples and apples. I mean, these work the same from the standpoint of function. You get a specific interest rate for a specific period of time that you choose. So, good question. That's the first question. Let's go to the other questions. I mean, they gave me a huge list, so it might take a while. So, let's do the second question. First of all, I like how he started this. Hi, Stan. I've enjoyed your videos and now have a question for you. Okay, I like the enjoy the videos part. I have two deferred fixed index annuities. Both have lifetime income riders. Now remember, you can attach an income rider to an index annuity at the time of application. The income rider is for a lifetime income benefit at the future date that you choose. He goes on. The way I understand it, you only need the income riders if you think there may be a possibility of needing the income prior to the end of the withdrawal period. Now let's stop right there. The income rider can be turned on at any time of the policy. You don't have to wait to when the surrender charges are over. You can turn it on at any time. It's an income rider. Now, obviously, the older you are, the higher the payment. The longer you defer, the higher the payment, but you can turn it on sooner. And he goes on, otherwise, if I didn't ever think I need the income from these annuities, I could have purchased them and let the withdrawal charge time period expire and then annuitize them and saved a pile of money for not needing the income rider. Do I have this right? So in essence, what he's saying is, I could have purchased an indexed annuity without an income rider, and then at the end of the term with the indexed annuity, I could have converted that and had me quote all immediate annuity carriers for the highest contractual guaranteed income stream, and then transfer the indexed annuity to a single premium immediate annuity at that time. Absolutely you can do that. That's what I call defer to SPIA. So you can buy the immediate annuity, and he would not have had to pay the income rider charges, which are deducted from the accumulation value part of the policy. If you draw a line down the middle of the page, indexed annuity, accumulation, the options on this side, income rider on this side, the fees come out of the accumulation value. So his question is, did I make a mistake putting on the income riders? Shouldn't I just bought the index annuity and then bought the immediate annuity down the road? There's no good answer to that, just bad sales pitches. I actually believe that you placing the income riders on the index annuities was a good thing. Why? Because you know to the penny what that future income stream is going to be, and understand that any fees are coming out of the accumulation value. They're not coming out of the income rider value. So that's not affecting the guaranteed income stream that you're going to get in the future. So in a perfect world, I mean, where you don't want to pay fees, could he have waited to buy an immediate annuity? Yeah, but there's no guarantee that that would have been a higher contractual payout than the income riders that he attached at the time of the policy. So, no good answers, just bad sales pitches. But in my opinion, income riders are great because you know to the penny. It's not a projection, it's a guarantee what that guaranteed income stream will be in the future. Let's go to question 3. How are your commissions paid? I.e., does any of that commission come out of the principal that an individual is attempting to put in the annuity? Now, first of all, great question. But second of all, there's many types of annuities. So there's single premium immediate annuities, deferred income annuities, qualified longevity annuity contracts, multi-year guarantee annuities, indexed annuities, variable annuities. We don't sell variable annuities. But all of those types, the commissions are built in and hidden from the client. I don't think hidden's the right word, but in essence, if you put $100,000 in, you're going to see $100,000 go to work in the policy. You're going to see $100,000 on that first statement. Does the agent get paid? Yes, but it's just part of the overall administrative cost, just like a company would factor in water bill, heat bill, electrical bill, commissions. That's part of the annuity administrative cost. So it's not going to come out of the amount. Now, for you semantically driven people, I was like, wait a minute, Stan the Annuity Man, that's kind of word game-ish, right? No, I mean, there's 100 pennies in the dollar, but it's just coming out of the administrative side of the ledger. So bottom line to the question, answer the question, you put whatever money you put into the annuity is going to work in that annuity type, whatever type that you choose, and the agent does get paid a commission. Now let's go to the next one. With life income with period certain or life income with refund, if the annuities funds run out in the middle of the period certain, are the disbursements still payable? So let's break that down a little bit. What they're saying is, I'm going to buy a life with, say, a 10-year period certain, or a life with a cash refund or installment refund. The key word here is life. It's going to pay you for the rest of your life, regardless of how long you live, as long as you're breathing. If you go to 175 and there's a medical miracle, it's going to do that. And let's just take the example of life with, say, a 20-year certain. If you live past 20 years, if it's year 22, it's still going to be paying as long as you're breathing. Now, what they were referring to, the money being in the account, remember, with all lifetime annuity types, whether it's an immediate annuity, a deferred income annuity, a qualified longevity annuity contract, or an income rider, that income stream you're getting is a combination of return of principal plus interest. There could be a time where that accumulation value or the value of the annuity, depending on what type of annuity that you chose, is at zero. That's fine. Now you're in the insurance company's pockets and they're on the hook to pay regardless of how long you live. I have thousands of clients that have zero in their account that have been getting paid forever. That's the return on investment that you don't know until you die. People always say, what's the return on investment, Stan the Annuity Man? I don't know that until you die. Great example. Now, why would you put a period certain or a refund attached to a lifetime income guarantee is because you want to make sure if your Learjet hits the mountain day 2, that someone's going to get payments, for that either specific period of time or a cash refund or something like that. Because with 10,000 baby boomers hitting the age of 65 every single day, most people have worked really hard for their money, and they don't want the annuity company to keep a penny, and we can structure it so that they will not. Or you can structure some type of what I call a backstop, so that if you die day 2 or you die early, or you and the spouse, if it's joint, die together early. I'm sorry to be so morbid, but we're talking about contracts here. We can structure it so that money can go to the beneficiaries, or we can structure so that 100% of the money can go to the beneficiaries. Bottom line, it's going to pay as long as you're breathing. All right, so let's go to the next one. I don't like how this starts. This is a little confusing, Stan. What benefits does an annuity provide in an IRA? Wouldn't a 1035 be more impactful? So let's talk about, let's go backwards a little bit. 1035 is the IRS code. If you're so bored and you want to read it, go to section 1035. And what that says is you can transfer one annuity to another annuity in a non-IRA account, and it's a non-taxable event. So you can go from XYZ annuity carrier to BDF annuity carrier, and it's a non-taxable event. Money just transfers, cost basis transfers. Okay? Not all annuity types are transferable, but in this case, I'm assuming they're talking about one that they have that might be transferable. Okay? But the question of what benefits does an annuity provide in an IRA? Well, there's a lot of advisors and masters of the universe and journalists that don't know a thing about annuities, and they'll say, never put an annuity inside of an IRA. That's dumb, number one, because there's actually a product, qualified longevity annuity contract, that was designed and introduced by the IRS and the Treasury Department for use inside of an IRA. But the answer to the question, which is why would you really put an annuity inside of an IRA? For the contractual guarantees. You own an annuity for what it will do, not what it might do. And the will do is the contractual guarantees of the policy, period. So contractual guarantees work in an IRA, not in an IRA, in a Roth IRA. Doesn't matter. You're buying the contractual guarantees. The only difference is how that if you bring money out, whether it's an income stream or withdrawal, depending on the type, is how the money is taxed depending upon the type of account that you have, non-IRA, IRA, or Roth IRA. So most people have a lot of their assets in IRAs. That should not preclude you from considering an annuity. You consider an annuity for a transfer of risk contractual guarantee, whether it's income or principal protection, whatever the solution that you're trying to solve for, it can be used in an IRA without hesitation. Last question. They only gave me a few, but this is the last question. Hey, Stan, what about if the insurer goes bankrupt? Does your annuity, this is good, does your annuity go into, I'm not going to say what they put. They use the word S, but I'm going to say pooper. Does it go into the pooper then too? Have you seen that happen before? I mean, insurers do occasionally go bankrupt. Example, and they gave an example of a company. Well, here's the bottom line with all of this. Fixed annuities are regulated at the state level. Each state has what's called a state guarantee fund. And I'm going to give you a website. Hopefully they'll put it on the screen. It's nolhga.com. That's the site that you can go and see what the state guarantee fund limitations are for your specific state of residence. All right? So if something happens to a carrier, that's going to be the first line, is the state guarantee fund. And a lot of people like to look at the state guarantee fund and then buy the annuity type with the dollar amount that's underneath that. Similar to FDIC, but I do not want you to be confused in any way. State guarantee funds are not as good as FDIC insurance. F stands for federal, okay, which means they can tax us and come get the money, whatever. So that's the best. Now, have we seen annuity companies be absorbed by state guarantee funds in the last 10 years? Yes, but what typically happens is they're lower rated companies, but other companies come in and buy them and buy up the contractual guarantees. And you gotta say, well, what does that mean? I mean, Why would they do that? Because annuities are confidence products. And the annuity industry is well aware that they do not want to lose any confidence with the consumer at all, and they want to make sure that the guarantees are in place. So there's a lot of self-regulation. I call it the annuity mafia because I love the Godfather movie, so let's call it the annuity mafia. But the big guys kind of oversee the little guys, and they really, it's pretty self-regulated. The other thing that you need to understand, fixed annuities, regulated at the state level. Fixed annuity companies, life insurance companies issue annuities. They're not smarter than banks. They're just more regulated than banks. They're not allowed by law to do crazy things with your money. I mean, they really have to be very conservative, have 100% of your money on hand day one. Does that, his question in the company that he gave, are there bad people in the industries? Yeah, every industry has a bad egg here and there. What I'm telling you is you have two lines of defense there. You have the state guarantee fund, and then you have the annuity industry itself that's self-regulating the industry. So, good question. All right, so we went through some questions. Hope you enjoyed that. Hope that you go to the comments section, put one in. We're going to answer it real time, but it might make it to the next video. And by the way, I appreciate you joining me on Stan the Annuity Man video, and I'll see you next time. Click the subscribe button on the way out.